Hello financial fans, welcome back to another stock analysis. Today we'll be covering Domino's Pizza, stock ticker DPZ. Domino's Pizza is a multinational pizza delivery company. They operate a network of company-owned and franchise-owned stores. They offer a wide variety of pizzas as well as side dishes such as breadsticks, chicken wings and desserts. Customers can order online through a mobile app or by phone for delivery or carryout. They also offer the option of ordering through voice assistants such as Amazon Alexa and Google Assistant. Domino's Pizza also innovates on the delivery process. They use GPS technology to track deliveries, and they were one of the first companies to offer online and mobile ordering. They also offer a loyalty program called Domino's Pizza Piece of the Pie Rewards, where customers can earn points with each order and redeem them for free menu items. Overall, Domino's Pizza is a pizza delivery company that allows customers to order food, track deliveries, and offers a loyalty program. They currently operate 19,519 locations, and their market cap is currently sitting at $12.3 billion. In 2021, they generated a revenue of $4.4 billion, and the dividend yield is currently sitting at 1.26%. 59% of their revenue comes from supply chain, 12% from the US franchise, 11% from US advertising, 11% from US company-owned stores, and 7% from international franchise. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, financial health, and the growth of the company. We'll be using a standard margin of safety of 25%, which can either increase or decrease by the ratios that we're going to look at in just a moment. The severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from the margin of safety. When we're using 3 colors in our scale, bright red will mean a 5% increase, orange will once again mean no change, and bright green will mean a 5% deduction from the margin of safety. First two ratios that we'll be looking at are the EBIT growth and the margin growth. The EBIT has gone from $282 million in 2013 to $780 million in 2022. The average growth in EBIT during this period was 12.1%, meaning a 5% deduction from our margin of safety. The margin has also gone up, going from 16.8% in 2013 to 17.9% in 2022. The average growth in margin during this period was 0.81%, meaning no change in the margin of safety. The next two ratios that we're going to look at are the dividend growth and the payout ratio. The dividend have gone up significantly, going from 80 cents a share in 2013 to $4.40 a share in 2022. The average growth in dividends during this period was a whopping 20.9%, meaning a 10% deduction from our margin of safety. Payout ratio is still sitting at a very solid 34.3%, meaning no change in our margin of safety. The final two ratios that we'll be looking at are the debt to EBITDA and return on invested capital. To get a debt to EBITDA ratio, we have to take the debt, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debts. For Domino's Pizza, it's sitting at just over 6 years, meaning a 620% debt to EBITDA ratio, which is considered very high, so a 5% increase in our margin of safety. The return on invested capital, on the other hand, is sitting at a very nice 46.4%, meaning a 5% deduction from our margin of safety. Let's go look at the valuation models next to determine the intrinsic value of Domino's Pizza. The first valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow going from 2012 to 2021. The average growth in cash flow during this period was 18.67%. And since we're calculating the expected growth in free cash flow up until 2030, I've gone with 60% of this average growth, which is 11.2%. With this percentage, we can determine the future free cash flow for Domino's and determine a terminal year of valuation using a perpetual growth rate of 3% and a discount rate of 8.5%. Out of this, we get a sum of future free cash flow of $17.7 billion. And all we need to do to get our equity value is add the cash and equivalents and subtract the debt. Out of this, we then get an equity value of $12.6 billion. And all that's left to do to get a discounted cash flow price per share is divided by the amount of shares outstanding. for Domino's, in this case, is 35.4 million shares. Out of this then, we get a discounted cash flow price per share of $356.84. And with the current price of $348.04, we get a small upside of $8.80, which is 2.5% upside from this model. The second model that we'll be using is the dividend discount model. I've imported the dividend payouts going from 4 years ago to the current year. The average growth in dividends during this period was 18.9%. And since we're calculating the lifetime expected growth in dividends for Domino's, I've gone with 40% of this growth rate, which is 7.5%. We'll also once again be using a discount rate of 8.5% in this calculation. And out of this model, we then get a price per share of $509.81. With the current price of $348.04, we get a whopping upside of $161.77, which is a 46.5% upside from this model. Final valuation model that we'll be using is the multiple valuation. By looking at similar companies to Domino's, looking at their stock price and their earnings per share, we can determine the average PE multiple in the industry, which in this case is 36.16. All that's left to do then to get our fair value is multiply it by the earnings per share that Domino's is generating, which in this case is $12.35 a share. Of this model then we get a fair value of $446.53, and with the current price of once again $348.04, here we get an upside of $98.49, which is a 28.3% upside. Let's go look at the final overview of our valuation models next. Looking at our final overview, we've imported the discounted cash flow, discounted dividend, and multiple valuation prices per share. Out of this we get an average of $437.73. Margin of safety we've determined earlier using a standard margin of safety of 25%, adding 5% for the debt to EBITDA, reducing it by 5% for the EBIT growth, deducting 5% for the return on invested capital, and deducting another 10% because of the dividend growth, which leaves us with a margin of safety of 10%. Adding this margin of safety, we get a fair value of $393.95. And with the current price of $348.04, we get an upside of $13.19. So in this case, we would consider it a buy. If there's any other companies that you would like to see on this channel, please let me know in the comments. And thanks for watching.